Let's turn to what could be a major moment of truth for this record rally. Earnings season kicking off tomorrow morning with Citigroup, JP Morgan, and Wells Fargo reporting results. On Wednesday, you're going to hear from Bank of America, Goldman Sachs, and on Thursday, Morgan Stanley. Will the big banks add more fuel to the market's fire? Or, Guy Adami, could we be in for a rude awakening on a sector that some might argue is priced to perfection, 2 times book value?
Well, depending on the metrics you look at, I happen to think they're priced to perfection. Look at Citi, for example, which is now trading close to, 1.7 times tangible book, right around book value. Talk about JP Morgan now trading north of 2 times book. These are lofty valuations in an environment where, quite frankly, I don't think they deserve it. Now, people will say they're cheap on a PE. That's fine. But in terms of price to book, you're getting to levels that we last saw 2008, 2009. And quite frankly, they didn't deserve it then. And I'm hard pressed to believe they deserve it now.
Well, if you look at things that are going to be related to net interest margins or loan to deposit ratios, which are as low as we've seen, I'm just looking at some data here since 1985, according to Fed surveys. There's a lot of things that could be headwinds, but here are the tailwinds. The tailwinds are the fact that the banks now are being run to be, I think, more aggressive in terms of their profitability, not just their balance sheets. And I think this is something that people are missing, except for the fact that the market is pricing this in terms of the re-rating. I don't think it's significant to go out and buy any stock for a dividend, but I think in the case of the banks, the fact that they're giving money back to investors, and I think that has everything to do with the breakout you're seeing in this chart. And I know Carter, anyone who's come on here has talked about this breakout of the banks. This has been a 10-year basing period, ultimately, and a re-rating period that I don't think just stops because you broke through or near resistance. You've broken through that. So I like the charts, but I think the fundamentals are fine.
Lori, the price to book ratio, and I'll look at JP Morgan just by itself, the rest are about the same, remained between 0.8 and 1 for about 8 years.
Yeah.
Now we're at 1.6 for JP. It's doubled in 3.5 to 4 years' time. Does it merit that kind of valuation?
Well, I think that's a bigger question about the market generally. Does the market generally deserve these lofty multiples? Probably no. And that's why I think you do have to go back to the relative valuation call. Where are things not quite as bad as they are in the market generally? And I mean, just to pick up on the point about shareholder return, I'll tell you one thing I really like about the financials right now. It's one of the sectors where we're still seeing buyback announcements ramp up. They're getting more optimistic about returning cash to shareholders through the buybacks as well as the dividends. We're seeing those buyback announcements start to slow in many other sectors. So to me, I think you've got a long, sort of a stable base here for a while.
Yeah, I would just add this, that the bank trade in the last few months is really about the Fed. It's about the Fed fixing the yield curve. Bank stocks did not like it this summer when we had the yield curve inverted. So we had those 3 consecutive rate cuts, and then we saw the expansion of the balance sheet. And if you look at what bank stocks have done versus the S&P 500 since early October, they've almost doubled the major money centers, the performance of the S&P 500. So it really comes down to, again, where do you think the Fed is? What are they going to be doing for the balance of 2020? And I would suspect, at least as far as the guidance that we get out of these banks, that it's going to be somewhat cautious given where the stocks have come, focus on the stuff that they can control, which is the return of the capital, that sort of thing. And, as far as capital markets and all that other stuff, it may be more volatile. That may be good for them. We just won't know that for a couple quarters.
Well, I also think if you want some insulation, I think your point's well taken, Dan, in terms of the Fed and the impact and them kind of papering over a lot of issues, literally. But if you look at the regional banks, they don't really have that same kind of repo exposure. And so therefore, if you are concerned, I actually think the regional banks should be more defensive here in this environment. The one thing you have to worry about, especially in the regionals, is they were very interest rate sensitive. And I don't think rates are going to get away from us here. But I do think there are reasons, and we see this in asset allocation right now, that has to do with we see inflation, we see reflation, and we see that in yields. That won't be great. That will be a driver for regional banks, but that won't be great for some concerns around credit.
All right. Good discussion on the financials. It's going to be a very busy week for those big banks and a very busy week for one Mr. Wilfred Frost.